Hello, everyone, and welcome to today's major markets update for Monday, April 11th, 2022. There is more blood on the street. What's going on? Are we topping? Are we just going sideways? This is a mess. Fourth waves are often long drawn, overlapping, and confusing. Are we still in one or are we in a bear market? But before I go there, I would like to share some other things with you regarding some economic aspects. And I hope I'm going to make a coherent story. It's a little bit hard to try to thread everything together, but let's start with the ECRI. This is the Economic Research Institute Weekly Leading Index, which has a reading of 161.1, the WLI Weekly Leading Indicator. It's up 0.6% from the previous week, which is, so this is from April 8th. And it is up 3.06% year-over-year growth. So there's still economic growth, and we, as you can see, are here at 3.06, not close to where previous recessions have started. Why do I want to bring this to your attention? Because I got this quite interesting email about suddenly everyone is obsessed about a recession. Well, most of the time when everybody talks about the recession, it ain't going to happen. Recessions happen most of the time when nobody's looking. Okay, so this was an interesting article about it on Yahoo. But remember, unemployment rate is at record low levels. Everybody's just quitting jobs 5 times a week. All those things, the profit margins are still at record highs. It's very hard to find anybody doing a contractor job for you. Everybody is really busy. So in that sense, it doesn't sound like there's a recession anytime soon. Housing prices through the roof might be cooling down a little bit. Doesn't sound like a recession. In recessions, we want to see nobody having a job. Everybody wants a job, high unemployment, housing prices subdued, all those things. So this sounds more like we're cooking over. So maybe the Fed is going to try to calm things down, as they say, do a soft landing, and maybe the Federal Reserve will actually be able to do its job by raising interest rates and taking some of the punch bowl called quantitative easing away. Another way of looking at this is here is the weekly leading index, and it's at its new all-time highs pretty much. That doesn't sound very recessionary, okay? Neither that one. Here we then look at the peaks with months before recession. Okay, this is the percent of the previous peak. How much are we below the previous peak? In other words, new weekly highs register at 100% and subsequent declines are plotted accordingly. So we're at 0% because we have just made a new weekly high. This is the weekly leading index. Okay, now going back here to 1964, this is the average time it took from going from 0 into a recession: 52, 39, 35, 10, 56, 25. And the oddball is, of course, the COVID-induced recession due to pandemic. So we'll take that off the books. And so do we do the early 80s recession, which means the lead time is on average somewhere around 36 weeks. So at the earliest, we can expect, on average, a recession 36 weeks from now. Well, there are 4 weeks per month, so 36 divided by 4, 9 months from now, which will bring us to late this year, early next year, at the earliest to get the recession, on average. Okay, so we're not in a recession at all. And if you look around you, at least in my neck of the woods, it doesn't look like a recession either. The roads are full with cars, everybody's gridlocked. Good times ahead, so to say. All right. Now, how is the weekly leading index growth over time? And it is still looking higher. Yes, we dipped below 0, I think a week or so ago, but that's not initially directly a sign for a recession. So we are still looking pretty mighty good on that perspective. Same here, we still look pretty good. We're not close to recessions. Okay, we're 3.4. So I think the case here is that we're not close to a recession. If anything, the earliest a recession can happen is in 9 months from now, based on average data. So everybody's talking about the recession. probably by the time it hits, we're all talking about something else. That seems to be most likely outcome. All right, so that brings me then to the markets. And what is the market trying to make of all this information, right? The price data is the aggregate of all this information available. Just what I discussed has been baked into price over many, many days and weeks and stuff. It's already baked in. So I'm just regurgitating what the market already knows. But the market is trying to make soup out of this, right? It's trying to make soup out of this data. Like, okay, the economy is growing, but we're kind of putting the brakes on. How much? Because the market is forward-looking. How I'm going to interpret that? Says the market. Speaking of the market as a entity on its own, but of course it's an entity made up of millions of people. But again, the millions of people know more than everybody separately. It's like an anthill, right? One ant will die and perish, it can't survive, but put a million ants together and they will conquer the woods, essentially. So let's go back in time and say, okay, how do fourth waves look like? Are we still in a corrective pattern? One of the things we want to look at is time. Time is, of course, precious. That's one, but it's also important. So we assume cycle 3 topped in 2000. It could be in 2007, but many people have it in 2000. It fits with the technology cycle, which stopped all the way there. So then we can look at how long did cycle 4 last. Okay, this long, from top to bottom, this long. Okay, excellent. So we're going to put that one here, which is about 9 years. Now, the next higher degree is a lower degree is the primary wave. This is primary 4. It lasted this long, which is definitely shorter. See that in time? It is about 1.5 years to 2 years, something like that. Excellent. Then we have major 4 here. Major 4 was in 2015 and 16. Okay. If you hear background noise, that's the wind. It is crazy windy where I live. And this one took this long, okay, about 9 months. So we can clearly see the difference in length of time for the different waves. So what is going on here? Did we already top for this 5 for 5 for 5? It is possible. It is not my preferred point of view. And I'll show you in a minute why. Also because of the fact that we're not yet in a recession. Here is this major 4 correction. So we're going to zoom in here in this time frame between 2015 and 2016. So zoomed in here, you can see the humongous mess this market had been in for all of 2015. It collapsed, it bounced, it dropped, it bounced, and then it dropped again. Okay, now we're going to compare that to the current price action. Do we see some similarities? So this is the current price action. Let's see if I can find it. Where is my comparison? There. Here we go. Here it is. So kind of try to mix and match, so to say. And we have the initial decline here. That was January of this year. Then we had the bounce here, which was into February this year. Then we had another decline here. And then we had the bounce. So far, so good. It aligns pretty well. And then eventually the market dropped, rallied, dropped, rallied, dropped, completing its wave. I know 9 out of 10 times when a market corrects, you will see instantly the analogs with 2007, 2001, 1929, etc. You see the same pattern leading into the current correction and then kind of the same pattern of the current correction. But that's because we're, of course, dealing with fractals, right? And corrections tend to progress reasonably similarly because we only have a finite number of patterns. We have 5 waves up going into the correction, and the correction itself is about 3 waves in whatever form or fashion, but most of the time 3 waves. So yes, it always looks kind of the same, but you need to know which wave degree each and every correction is. If you're comparing a major 4 of a primary 5 versus a supercycle 2, yeah, apples to oranges, about a similar pattern. So this still looks reasonably good. Initiation wave, bounce, another drop, bigger bounce, and then the last drop. So are we in the starting gates of this larger wave 4? Did wave 4 not yet bottom? It is entirely possible. As I showed you, fourth waves can take quite a long time. Cycle 4, almost a decade. Primary 4, multi-year. Major 4, multi-month. We haven't had a multi-month correction. We've only rallied essentially unabated since March 2020. So maybe it's time to shake off all these newbies out of the market. Everybody who's joined since the COVID pandemic started. It's maybe time they face their reckoning and understand that markets can correct for a considerable amount of time, even in an ongoing bull market. 2015 to 2016, 9 months of a correction, but the bull was essentially alive and well. 2018 to 2020, the bull was alive and well. So we can keep on going and go. We can do the 60s, we can do the 70s. Very little progress over 2 decades if I would show you the chart. So things can go sideways for quite a while. So far, this still looks like a reasonably similar pattern. And this again in 2015-16 was a major 4. And I have the preferred view that this is also a major 4. Zooming in further, this was my wave count that I've been, let's see here, sorry, where is it? Yes, the wave count was here. I'm missing a chart there of 1A, 2B, 3C. We overshot a little bit and we had the bullish cutoff here at 4,390. So we have a warning because we went below 4,430. So this is starting to get awfully close to the notion that this is not going to turn into 5 waves up. But no harm done. We had already on the chart that this was then in February, wave A, and then the bounce was wave B, and we're now in wave C. Very similar to what we had here in 2015 and 16. So far, nothing out of the ordinary. Okay, wave A, wave B, wave C. So that matches quite well. And it looks like the market is trying to turn this into a ABC pattern, unfortunately. Shorter term, again, we're not yet below the bullish cutoff, but it starts to get awfully close. It just takes pretty much one sneeze by the futures market and we'll be below it and we will not have 4 waves higher. Yes, we had 5 waves to the upside in both occasions. This was clearly 5 waves, very corrective overlapping price action to the downside, another 5 waves. Even in the futures market, if we go to the futures market, also that one had nice, clean, crisp, clear 5 waves to the upside and corrective price action to the downside, as I shared with you on Friday. So this was 5 waves, corrective, 5 waves, loud and clear, and now correcting. But we're starting to go to low almost, okay? I don't want to see this overlap happening unless my wave count is wrong, and I'll show you, of course, that the fact that the NASDAQ can have done already wave 1 top. So this also tells me we have a lot of different wave counts out there. The semiconductors, the IWM, the NASDAQ100, the S&P 500 / Dow Jones / futures market, all of them appear different. That often tells me we're in some sort of larger correction. There's no rhyme, no reason, or very little alignment, as I pointed out on Friday. I'm sorry about Friday's update. It might have sounded a little frustrating, but we're sometimes in these market conditions where nothing matches, where I say this is easy, and then it gets difficult. So I'm only human, but still I got some nice feedback on that update. Then let's go have a look at what other people are seeing. So this is from Gilbert's work, ElliottWaveTrader.net. They were looking for a 4th wave low and already at the starting gates of the wave 5, the one that I was tracking here, this wave 5. Well, that didn't come to fruition. So also they are still tracking the possibility that we're dealing with a alternative B wave, and we're going to go down to the 4,000s one more time for this C wave, which then again would be this same pattern. Because look, in 2016, we pretty much got to the same levels as we did in 2015. Not too much of a difference. It's marginal. I know intraday it might look horrible, but in the bigger picture, if you bought here and hold, you would have very little downside comparatively, right? That's the whole idea. You always see the forest through the trees. So what are other people seeing? Well, I just wanted to share you this work, for example, of a large triangle developing. This is work by, I believe his name is Option Flies. All right, sorry, the reference is here, optionflies.com. I don't know if his work is good, but what I like is it's all threes, loud and clear. A, B, C, A, B, C, A, B, C, A, B, C. It's all threes. All threes is corrective price action. I don't see any impulses to the downside. I cannot make this 5 waves. It's impossible. I cannot make this 5 waves. It's impossible. It's ABC. And this is 3 waves. This is 3 waves. It's all 3 waves either way. So this person here is looking then for a bounce and then a drop. Okay, I'm fine with it. That fits with what I'm looking for in the NASDAQ. I'll show you that in a minute. And then, of course, we have here the bullish option that we're in this impulse higher. Well, that one is almost off the table, so this one can be scrapped. And then, of course, we have the S&P 500 option according to Xenia Financials that I shared with you, where we have A, B, C, for example, and then we go lower, or we have 1, 2. So again, many options on the table. So when there are many options on the table, it smells of a large correction. Not so certain if we're going to get this wave 5, right? It starts to really fall apart unless this is some sort of diagonal, all the nastiness. And here's a work by Pretzel that we could drop all the way again below the February lows and then rally and then drop again. This is very extravagant, I must admit. Again, this is a wave 1 low here, but I don't think that's possible because this is 3 waves lower, just as we saw here, A, B, C. So I don't like it, but again, this would fit a little bit better with the 2015-2016 analogy. So here we have then pretty much 1, 2, 3, 4, 5 different analysts and almost 5 different outcomes with some similarities, of course, with the recent high being a B wave top. Okay, so that's still the best alternative versus potentially it being a first wave high, also possible. So again, as I said on Friday, we are currently in a very uncertain market environment, treated accordingly. We have not seen any decisive breakout or breakdown. That brings me to the IWM. I wanted to show you the IWM to acknowledge how difficult things have been, okay? I'm going to zoom out first. Let's go to somewhere like this. Okay. Now, this was easy, all right? From September pretty much to here, this is easy. This is what we want all the time. Look at this. Just you buy the dip, 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 right? Easy. It's just straight up. This was not easy. This was relatively easy to interpret from an Elliott wave perspective as well. You know, you can clearly see the waves developing 1, 2, 3, 4, 5, 6, 7, 8, 9. That's an impulse, loud and clear. Not easy. Okay. And then from March to November was not easy. Okay. Even here, then I say that was relatively easy. Okay. This was relatively easy. We had an A, a B, and a C, but not easy. All right. It was relatively easy. And now we're again in a not easy market. I wanted to show you this to really acknowledge that markets can go from easy to not easy, and again to easy or relatively easy. So they flip-flop all around a lot, and this price action here is a utter nightmare. All of 2022 has pretty much been a utter nightmare again for the Russell 2000. The best I could come up with that this is an A, a B, and a C of a larger B wave bounce, and we're now on our way lower. Okay, we did almost 50% retrace of the entire decline, which seems very reasonable for a, in this case, flat wave B, A, B, C. It's all, I know it's all ABCs. Make of it what you want. I call it a flat, maybe it's not, whatever it is, it's all ABCs. This is all ABCs, ABC, ABC, ABC. So it's extremely difficult. So that we then break down and go, man, I didn't anticipate this because we're all dealing with ABCs. ABCs are the hardest to interpret. Zooming out, seeing the forest through the trees, it looks best as if we then topped here for a B wave. Now in the C wave for primary 4, and then we get primary 5. It would align very nicely. I'm still missing this larger 5th wave. Still not seeing a larger 5th wave unless it was an utterly failed 5th wave. For this B wave, I don't like it. Also because this price action that we've seen since the November all-time high in the IWM is overlapping. It's very hard to make this all ones and twos and ones and twos, and that we're now going to crater for the third of a third wave. I don't see it, and I think that is very nicely exemplified by this pattern, right? The ABCs. It's all ABCs, both upside to downside. So it's not been easy. So 2022 has not been easy, okay? That brings me then to the semiconductors. Also this one, I had to adjust the wave count as we are dropping way too high. Remember, I originally had the primary 4 here in March. This as a leading diagonal first wave, and we should then have been in this major 2. But we started to drop way too low, and I think we're finishing up this cycle of this C wave in a impulse fashion to entirely retrace this wave 5 here. Oh, that's not a 3, that's a 5. We need to retrace this entire wave 5. Remember, sentiment is of course extremely bearish. It won't get any better today. So at some point we might see a nice strong reversal. And the IWM is now at levels from where we can start to expect better upside reward versus downside risk. That brings me then to the NASDAQ100. It already broke below its bullish cutoff level. That one was passed on Friday. That was already the warning, and we broke even lower today. It still looks like an impulse lower. I had to move. I was originally looking here for a low at around 14,145. If you remember Friday's chart, because that was a nice 200% extension. It looks like this wave 5 of wave A is extending. So expect this A, a B, and a C. That is still what I expect. If we start to drop much lower, then we have to adapt the wave count that we have for the S&P 500, that we had just a B wave of a complex, also A, B, C type of pattern. And we're going to follow the 2015, 2016. So again, we have a plethora of options on the table that I'm not yet able to elucidate. That's why I always say in the summary slides, we always want to know exactly what's going on, but there are times that we won't know what's exactly going on, regardless of all the tools that we have available. Again, these were easy times, just as I showed you for the IWM. But this is easy times when things move higher in an impulse pattern, the 3, the 4, and the 5. Okay, then things don't get easy. This was then an easy one, by the way. The bullish wedge breakout was targeting 15,200. We got to 50,270, somewhere around there. So that was easy. That was the easy one. And now things are not so easy. And the index failed to make, in my humble opinion, the similar pattern as the S&P 500 is doing a lot worse. So now my preferred view is for A, a B, and a C. And this wave 2 can easily be a very deep retrace. It would fit here with what Xenia is looking at. On the other hand, it wouldn't fit with, for example, this A, B, C pattern. Okay, we'll make it work somehow. It will fill it in. I think for now, the easiest trade is not to trade, so to say, sit on your hands, stay in cash, and minimize any losses you may have, and let this all play out. So I hope it was a coherent story. I tried to do my best to kind of tell you what the market is trying to figure out with where we are in economy-wise versus what the Federal Reserve is doing. With the tightening and the interest rates, and how bad is this all going to be, with of course a lot of other information out there. So we're really trying to make sense of it, and why this then would fit with the idea of a larger fourth wave, because of all these, I would say, currents that are going on, pushing and pulling the markets in different directions, which is trying to make sense of it. So the bottom line for today is that there are still several Elliott wave options available because the indexes are misaligned out of sync. All right, I showed you those, and I've showed you the work of other people, and all of them are pretty much confused with some general, of course, agreement that we could have topped for a B wave, where we could be in a larger triangle, could be in a 1-2 setup. So there's a lot of uncertainty out there, and also to show you that Elliott wave does have its limitations when we are in this type of soup. Okay, so this doesn't make my analysis any easier because each index must be analyzed on its own. I can't refer to the semiconductor, say, oh wait, that was a wave 4, to apply that label to the S&P 500, just as we had, for example, in the 2000s. So it definitely makes for difficult analysis. Again, not washing my hands in innocence, but remember the market environment we're in, and it's difficult right now. Again, I have the preferred wave count for the NASDAQ100 as a wave 1-2 setup, and with wave A of 2 soon to be completed, and then a wave B, and then wave 2 should become a zigzag. Okay, the Dow Jones still prefer the wave 5 of 1, but honestly, I think that's now under pressure. So that one is starting to look more like the one for 2015, 2016. So I'll change that to the wave B. Scenario becomes closer to being preferred. We're still above the bullish cutoff level, so it should allow for this wave 5 of 1 to play out, but the odds are really getting low because we broke below 4,030. Semiconductors now look better with the revised count, that we're in this 5 wave C wave lower. So far, so good. Revised count is now almost getting confirmed. The IWM remains messy and overlapping, also seems typical of a 4th wave. Lots of ABCs this year, hard to make soup of, and the count I've presented to you, I think, is so far the best interpretation of the price action. Showed you that the economy is not in a recession. It will take on average 36 weeks from now to get into one. All right, maybe what the Fed is trying to do is to cool things down, a soft landing. Will they succeed? And is the market trying to figure all of this out? That would fit with a 4th wave as well. Again, the similarities between 2015 and 16 fit quite nicely, which was a 9-month-long correction. Yes, they can last that long. We can have a 2 months primary 2, and then you have a 2 years or 1.5 years long primary 4. It's absolutely possible. 4th waves are very tricky. So I'm more and more in the ballpark of, or in the camp, sorry, not in the ballpark, in the camp of this being a more drawn out wave 4 than originally anticipated. All the bullish and bearish Elliott wave counts appear valid. I've shown you both. It's a little bit of anybody's best guess. We have 5 Elliott wavers, 5 or 6 different wave counts. Suggests confusing price action, but I think the best is yet and still 3 waves down, 3 waves up, 3 waves down, a lot of 3 waves, which is a hallmark of corrective price action, and a larger 4th wave. And now we simply have to let this 4th wave play out. Is it going to be a straight, simple C wave lower? Nothing will just simply go straight down. I expect this bounce soon. Again, a reset of this very bearish sentiment that we already had late last week, and it's probably only getting more and more bearish. So please take that into consideration. On Wednesday, we'll review some of the BREF indicators. Let's see if they are close to bottoming as well. And then on Friday, we can again reassess sentiment, see if we made a dent in that one, or if people are even more bearish than they already were last week. But again, price comes first, then comes market BREF, and then comes sentiment. All right, so I hope this helps. Again, we're very close to the bullish cutoff levels on the S&P and the Dow Jones. Seems like we're going to breach those. We already did that for the NASDAQ100, and you can see what happens when those get breached. Then we have to adjust the wave count. Instead of a 3, 4, 5, then we've placed the wave 1 top already on it. And if we start dropping too low, it becomes a B wave, just as we had for the S&P 500. So still a plethora of options out there. Eventually, we'll move to a much clearer picture, which is a trending market to the upside. Those are much clearer. Right now, a lot of things are moving sideways, and that they're stuck between a rock and a hard place with little progress. All right, so please take it easy. Please take care. See you all on Wednesday. Bye.